Hey guys, welcome back to another video. Well, we have finally reached it, the last quarter of this roller coaster of a year. Personally, at the start of every single month or every single quarter, I have a lot of hope because for me, it's kind of like turning a new leaf, starting a new chapter, starting fresh. Now, it should come as no surprise that for the past 2 years, regardless of the fact that I have hope every single month and every single quarter, over the past 2 years, I have been disappointed. But as I always say, hope dies last. So since we just entered a new chapter called Quarter 4 of 2023, it's time to look at the culprits of the problems we face today in the industry and how they might change in the near future. If you're new to my channel, welcome. I teach about the trucking industry with a heavy focus on the spot market as well as freight market analysis. So if this is a topic that interests you, feel free to subscribe and join an amazing community of industry professionals who you will learn from every single day, just like I do. So what are we looking at today? Well, for the most part, we're going to try and understand what is awaiting us in the next few months. We will talk about freight volumes and truck capacity, and then we're going to try to pinpoint what is the actual issue that is causing the crap storm of today. And then we're going to move to some theories of what will happen next. Ready? Let's go. So historically speaking, quarter 4 is an interesting time because this is when we're moving out of the peak season, historically when volumes are crazy because there's crazy demand and it takes rates with it, into holiday season where demand is elevated and also there are tight deadlines for when the product has to be delivered, therefore usually giving an opportunity for the trucking center to earn a little bit more than usual. Now, unfortunately, we have already seen that produce season this year was muted. Peak season, unfortunately, has also been muted quite a bit, although there was a moment where there was a glimmer of hope when tender rejections started climbing like crazy. But unfortunately, as we have seen over the past few weeks with those weekly market updates, unfortunately, those tender rejections made a U-turn and are going back down and are continuing to decline as of right now. So one of the questions, of course, is this holiday season going to provide some relief finally? And if it is going to be muted, why? Before we do anything else, let's take a look at some historical data. I know you guys are familiar with these charts already, but let's look at it from a different perspective, starting with the outbound tender rejection index. Unfortunately, as a reminder, Sonar only provides data 5 years back because that is when they started tracking it. Now, over the past 5 years, I'm going to move this right here. This is the blue graph, and these are going to be attached down below. But the month of October, the blue line, we can see that tender rejections are historically in October not doing well. From the beginning of October or the first quarter of October, rejections start kind of going down every single year. We can see it right here. We can see it here. Here it's a little bit more level. This is actually 2022. And this line right here, we can see it going down. Now, the blue line at the bottom, that is us right now. And that makes it even scarier. Why is that? Well, let's take a look. So I labeled these just so that you can understand. So here we have the 2018 levels. In 2018, we started with a rejection rate of 17.6%. In 2019, right here, we started with a rejection rate of 5.31%. In 2020, it was 25.79%. 2021, which is right here, was 21.82%. That's where we started in terms of rejections. 5.31% for 2022 levels. And currently for 2023, we are starting with a rejection rate of 3.62%. Now, if you take a look at this data for the month of October closely, what you will notice is that from the beginning of the month until the end of the month, tender rejections tend to fall by 1 to 2%. So the only question I have as of right now is how far will the tender rejection rates fall in the month of October this year? And if it keeps with the pattern of falling by 1 to 2%, are we seriously going to see a 2.5 or even a 1.5% rejection rate at the end of October. In just a few minutes, we're going to take a look at what is actually driving those tender rejections down. But for now, let's take a look at November and December. November is green, December is the purplish red color right here. So if we look at November, we see that somewhere towards the middle of the month, every single year is when rejections start actually climbing. Then they tend to fall in the beginning of December, and towards the end of December, they start kind of skyrocketing up. And that is very clear to me. Towards the end of December, capacity starts exiting the market because everyone wants to spend the holidays with their family. All right, as promised, the question is, what is causing such horrific rejection rates this year? If we look at this chart, which is the volume chart, these are the different years. The blue line right here, this is us right now. We can see that every single year, again, this is October, November, and December. Every single year, volumes are more or less stable through October. They do sometimes decrease in November, then they take a hit during the Thanksgiving holiday, and then they kind of pick up and go down towards the end of the year. Now, if we're looking at the big picture, what we can see is that volumes this year are strong. First of all, they have been slowly, steadily going up since the beginning of the year. Second of all, we are actually above the 2019 and 2018 levels and are kind of creeping up towards the 2022 levels in terms of volume. So if volume is not the issue, we can see it's remaining strong, then of course capacity has to be an issue. Why? Well, it's simple, because of supply and demand. Regardless of the amount of freight available in the market, if capacity exceeds that volume, rates are of course going to slip. Now, sadly, there is absolutely no way to figure out exactly how many trucks are actually on the road right now. Right? We can look at MC numbers and how many authorities there are, but the reality is every single carrier might have a different fleet size. And out of that fleet, not all trucks might be dispatchable, as in ready to run and pick up a load. Trust me, I have tried looking for IRP data, IFTA filings, IFTA data, all of that stuff. And unfortunately, I was not able to find anything that would point me in the direction of figuring out exactly how many trucks are actually operating right now on the roads, dispatchable trucks, not those that are just sitting there. I'm 100% sure that the data does exist. It's just not available to the public. However, I'm not here to disappoint you guys too much, because I did find something that might provide us with a little bit of a clue. What I did was I looked up the statistics via the IRS of e-filings of Form 2290, right? If you have a truck that has a gross vehicle weight of over 55,000 pounds, you do have to pay for this 2290. Depending on when you start your operations is when you're going to actually have to pay it for the first time. But in general, everyone has to renew it annually by July 31st. Now, sadly, it does not tell us the type of equipment. It can be just a regular truck, a semi-truck, truck tractor, or a bus. It also does not yet give us the July numbers, unfortunately, and those are the ones that are really important, because that is the deadline of having to renew this 2290 heavy vehicle use tax. So these would be really important, but nevertheless, we'll get a little bit of a better idea. So I did include a link down below for you guys to be able to access this data. But for now, I took this and I cleaned it up and I went from 2018 until 2023. So it's by month how many e-filings happened every single month of every single year. Now this is too small to see, so let's take a look at this chart. This is the total filings up until June. So every year, we're just looking at numbers, total numbers from January to June, right? So here it is. And what we can see is in 2023, the filings did decrease, but very slightly from 2022 levels. They are around the same as the 2021 levels when it comes to filing that 2290. Just to give you some numbers, this year, 2023 so far, we had 223,460 filings, By June of 2022, there were 233,764 filings. And by June of 2021, there were a total of 220,993 filings. Just to give you a comparison, this is 2020, 2019, and 2018 levels. Now let's take a look at these same numbers, but on a monthly basis. Whoops, let me find it right here. All right, so we have January through December, and these are the years. Again, these will be attached down below if you want to take a look at them closer. Unfortunately, we only have data until June right here for this year. But something we can notice right away, we are the orange line. 2023 is the orange. Everything before is the previous years. We can see every single month we have seen a decrease in the amount of filings this year. However, as I said before, all of these are new registrations or re-registering, refiling it for a truck that was not in use for a while. The renewals actually happen in July. This is why every single year, this is where they are the greatest, right? So this would give us a better idea of whether existing carriers are actually renewing their 2290. Now, considering the amount of carriers that are consistently declining week over week, I would predict that this number is going to be much lower than the 2022 number, because if carriers are downsizing or even shutting down, they're no longer going to be paying the 2290 tax, $550 per truck. If you're operating a semi-truck every year, who needs it? But basically what this shows us, and I'm going to go back to this chart, is that capacity really is decreasing, right? It is decreasing, we can see it. But it's more of a drip out of the market instead of capacity flooding out of the market. In other words, capacity is the biggest reason for the rates we see today. So the question right now is no longer about volumes and what we expect volumes to do next month. Now, of course, we should still wonder about volumes in terms of what is the consumer demand like? What is the consumer confidence index like? But currently, the biggest issue is capacity. So that's where the focus is. What is happening on the capacity front and what will happen in the future? Now, we have all seen that carriers are pretty resilient folks. And while some are definitely shutting down operations because of the unimaginable conditions in the trucking market, we can see if we look at the big picture that for the most part, the rate at which carriers entered in 2021 is significantly higher than the rate at which they're exiting in 2023. All right, let's theorize here. We all know that the price of diesel is continuing to go up and up and up with no end in sight. Now, this means that your expenses are also up. At the same time, we know that the spot rates as well as contract rates are going down, more so the spot rates at a quicker pace than contract rates, but those are going down. So your income is going down, which means, of course, that your net is also going down. I think we can all agree on that. Now, we also know, and this is according to FTR, I'm going to quote this, the August level of new truck orders continues to be below replacement levels. And that indicates that most people, a majority of carriers, is operating old equipment, old junk. Now, if you need a reminder, we spent over $40,000 this year alone in repairs for one of our older trucks. Why? Because older trucks, they're no longer under warranty, unless, of course, you buy aftermarket warranty, but most people don't. And new equipment is costly, so given the current market situation, of course, most carriers will not be able to afford buying new equipment at the moment. What does that mean? Well, we know that those junker trucks, the old ones, they need to be repaired. We know that the cost of labor is going up. Excuse my chicken scratch. We know that the cost of parts is going up. Again, reminder, we spent $40,000 on one truck this year, and this is not the whole year so far. It was only until April or May, I don't even remember, $40,000. So this further increases those expenses and decreases that net income for most carriers because, again, most carriers are forced to operate older trucks. Now, what is another thing we know? Well, we know for a fact that contract carriers, or the contract market, is pretty resilient. If we look at this chart that we look at every single week, we can see that we're back to a spread of 78 cents per mile, meaning contract carriers are now earning 78 cents per mile more than spot carriers. Last week, it was 76 cents per mile, but we have been at this kind of average level for a while now. I'm going to show you another chart by fifth wheel freight. This chart only goes until quarter four, unfortunately, of 2022, but look at the stark difference. So we have, this is the contract rate per mile. Let's look at quarter four. Contract rate per mile average was $2.62 per mile, whereas the spot average was $1.97 per mile for spot carriers. So that means that contract carriers, they are doing better, but that also means that they have had a bigger, a thicker cushion that is kind of shielding them from the current market conditions. They can survive longer than these spot carriers given the stark difference in the rate per mile. Now, here's another theory that we have actually, it's not a theory, it is a fact. We have talked about this in the comment section quite a bit. We know that contract carriers are getting their contracts renegotiated more and more often. This happens because shippers are trying to grab that opportunity of having to pay less, and their calculations are based off the spot market conditions. So every time the shipper renegotiates is a time when contract rates start going down. Now, according to Freightways, and I quote, traditional bid season during which the bulk of shippers send out RFPs for transportation providers to submit prices for their services for what is typically a year occurs in quarter four into quarter one of the following year. Implementation for the new rates tends to occur in quarter one to quarter two. This means that contract rates typically stabilize through the middle of the year. We also know that contract rates typically follow the pattern of the spot market, just with a delay. So this is a chart by Sonar. The blue line is the contract rates. The white line is the spot rates. This is before any fuel surcharge. So we can see that, yes, spot market goes down, so do those contract rates, but they're significantly higher. If you want to see numbers, contract rates are at 227, spot rates are at 158 before fuel surcharge, right? So pretty dire situation. Considering the fact that spot rates are continuing to decline, and considering the fact that renegotiations, or the bulk of renegotiations, happen this quarter and next quarter, we can expect that shippers are going to continue trying to grab those relatively better transportation rates by renegotiating to a lower rate, and that is going to drive contract rates down. If the bulk of the shippers start renegotiating to significantly lower rates with their contract carriers, those contract carriers' cushions that is so thick right now is going to start thinning out, and they're going to start really feeling the pressures of the freight market currently. Maybe not as much as spot carriers, but they will start feeling quite a bit of that. And that is something that could potentially start driving the contract carriers out of the industry. Now, if more contract carriers start leaving the freight market, of course, those rejection rates are going to go up, because contract carriers are going to be forced to reject extra loads simply because of a lack of capacity. As tender rejections start increasing because of the lack of capacity in the contract market, more volume starts hitting the spot market, where capacity is also actively decreasing. As more volume hits the spot market, it starts soaking up that existing capacity, and it starts kind of tipping the scale, the supply and demand scale, to the carrier's favor. Basically, there will be a situation where there's more freight volume than there are trucks. So what are shippers and brokers forced to do? Well, they're forced to provide an incentive to find capacity. Incentive means that those rates start increasing. Now, as spot rates start increasing, guess what contract carriers do? contract carriers start rejecting more loads because of a better alternative they find on the spot market. Remember, just because you're a contract carrier doesn't mean you're bound by that contract. Those are called paper rates. And that will, of course, increase those rejections, pushing more volume into the spot market. Now, of course, what this will end up doing is creating a cycle like we are in right now. As rates start going up, more people get into the industry hoping to make more money, and then they kind of dilute that supply and demand. And of course, rates start going down again. So yeah, taking all of that into consideration, number one, the fact that volumes are not currently the problem, capacity is. Number two, the fact that contract carriers have, for the most part, been more shielded from the current fluctuations in the freight market compared to spot carriers, of course. And considering that the bulk of renegotiations of those contract rates usually happen in Q4, so this quarter as well as next quarter, my personal thought is that Q4 of 2023 is going to be kind of blah. But Q2 of 2024 is when things might start seeing some positive change. Now, of course, a prediction is hard to make. That's why I'm calling it just my thought, because honestly, the freight market, it is affected by so many things, such as the consumer confidence index, what consumers are spending, and that changes every day, what consumers are faced with, for example, student loan repayments, right? And the list goes on and on. But for today, at least we know that the biggest issue is the fact that this industry is just overflowing with trucks. And volumes, while they are remaining strong, no one can deny it, they're simply not high enough to be able to provide enough volume for the overflow of capacity. Anyway, guys, I hope this was a helpful topic to try and understand. I hope that it made you understand the moving pieces and how everything works. In either case, regardless of what the market is doing today, we have to all remember that it does change eventually. So keep strong, keep your chin up, and I will see you in the next video.